Let's get into stock charts. And stock charts are not the end all and be all when it comes to trading, but it's a pretty decent equalizer. As I've highlighted here, everything known or knowable about a stock is reflected in the current price, including fundamentals, institutional buying and selling, the information advantage that big Wall Street firms and major hedge funds have that we will never have. Fair or unfair, legal and sometimes illegal, it's reflected in the stock chart. And I don't mean this in the efficient market theory sense that you may have learned in college. I mean this in the price and volume technical analysis sense. Before any major news announcements hit the financial media, more times than not, that news is already reflected in the stock's price movement on a stock chart. Once you understand how to identify those footprints, you're able to participate in that information advantage because the price chart reflects people's real-time actions or reaction to the things they know, think they know, or have heard. Bottom line, without a stock chart, I would not be anywhere near the markets. Albert Einstein once said that if you can't explain it to a 6-year-old, you don't understand it yourself. This quote really reinforces the basic concept of the Gabrielle trend. In other words, simplicity is the key when it comes to the upfront analysis of a chart. And I'm calling this initial analysis the Gabrielle trend, named after the straightforward trading lessons I shared with my daughter Gabrielle when she was much younger. In other words, my goal with her was to make the initial chart analysis so clear that even a child could determine if they are a buyer or seller. Gabrielle's initial charting lesson went something like this. I showed her stock charts using companies she's familiar with just to bring her into my world just a little bit. Companies like Disney, McDonald's, Hasbro. I told her if the stock is going up, clearly going up, you want to buy. If it's going down, you want to sell. But here's the key. If you can't decide in less than 2 seconds what you want to do, we pass. We move on. So I'd show her a stock chart. I'd say, hey, is the price going up or down? She'd say, up. I'd say, well, what do you want to do? She'd say, buy. For a downtrend, I'd say, is the price going up or down? She'd say, down. So what do you want to do? Sell. Now, we're not talking specific entries at this point. We're simply talking about our initial assumption. Since no one on the planet can predict the future price movement of any stock legally, we rely on the efficiency of the stock chart, price action, current momentum, etc. We'll leave the predicting to people who get paid whether you win or lose. They love predicting. We make assumptions based on technical analysis, then hedge those assumptions immediately. Risk management is key to your success. Controlling your downside is really the only thing that you can control in the stock market. That's the master skill that we'll cover later, but I digress. I've added another element to the chart, a simple 50-day moving average, and it's just that, the average of the closing prices for the past 50 days plotted out. For now, let me give you the top two signals, conditions Gabrielle had to spot before she could buy a stock. The first signal you already know, with one small addition. I told her if the stock is going up, clearly going up, without huge pullbacks in price, that's important. That's the first signal to buy. The opposite being true if the price is clearly going down. And I would say to you, it's just inertia. Thanks to Sir Isaac Newton and his laws of motion, we understand clearly that a body in motion tends to stay in motion until acted on by an external force. In the markets, daily fluctuations are to be expected, and they create endless opportunities. But in terms of that force, it takes a major jolt to knock the markets off its axis. I'm talking a season of negative economic news, extremely overpriced or underpriced markets, serious global threats. Corrections are normal. Crashes are almost always event-driven, and they create amazing opportunities for skilled traders. So we always favor the prevailing smooth trend. That's the first signal. The second signal involves the position of the stock's price relative to the 50-day moving average, that purple line. If Gabrielle is considering buying, the stock price must be above the purple line. If she's selling, it should be below the line. The 50-day moving average is simple, but it's powerful. It's a powerful tool to gauge the stock's overall trend and momentum. I'll eventually layer on additional criteria, of course, but this initial screen is a very big piece of the puzzle because bottom line, if I'm going to be wrong, I want to be wrong in the right direction. This alone can cover a multitude of errors. Now it's your turn. Take a look at this chart and just go with your first instinct, your gut. Decide if you're a buyer, a seller, or pass. I know it almost seems silly. Just look at this body in motion. No erratic pullbacks, just a steady march to the bottom. And really think about what you're seeing here with your greatest wealth building tool when it comes to trading, your own two eyes. Because even if the fundamentals, the balance sheet, cash flows, if they suggest that this stock is a good investment, you would never want to cross your fingers and buy it when it's in a nosedive like this. Now, if you've done your research and you're convinced that this stock is a good buy, we simply wait until the stock shows strength. Remember, as I stated earlier, everything known or knowable is reflected in the current price. Supply and demand drive the markets. Large institutions are the primary drivers, not retail investors. If large institutions were involved as a group in this stock, it would not be dropping like a rock. That demand would demand that this stock's price move upward. So what about now? Buyer, seller, or pass? Yeah, we're definitely a buyer. Now, as you'll learn later, there's no current entry here, not yet. But if this chart sets up, as long as it's above that purple line, we're definitely a buyer. And one last time, what about now? Would you be a buyer, a seller, or pass? Yeah, while the price is clearly above the purple line, we would not have made it past the first condition, a smooth up or down trend. This stock is just a little too erratic. So in this case, we would simply pass. Trading gives us that luxury. As we complete this section, I have one final and very important point. Before we even think about buying or selling, we need to first understand the current temperature of the market as a whole. And here's a quick and easy way to do it. We pull up the S&P 500 ETF, symbol SPY. And I'm covering ETFs shortly, but for now, all you need to know is that the S&P 500 represents the price movements of a basket of 500 of the largest companies listed on U.S. stock exchanges. So why is this important? Well, 75% of stocks as a whole will follow the overall trend of the S&P 500. We want to swim with this current, not against it. This is how we check the current temperature of the market. On the stock chart, we're using the same 50-day moving average, this purple line. And going forward, I want you to think of the purple line as your long-short line or buy-sell line, however you want to think about it. If the price of the S&P 500, the SPY, is trading above this line, we focus on buying stocks that are above their 50-day moving average. Conversely, if the SPY is trading below this line, the opposite would be true. This approach ensures that our trading decisions are in harmony with the overall market trend.